frequency activity indicators point to slowing momentum. Based on our analysis, as of the end of August, the average tariff rate on merchandise imports to the United States is estimated at 19.5%, which is higher than at any time between the mid-1930s and 2024. The full effects of these tariffs will become clearer as firms run down the inventories that build up in response to tariff announcements and as the higher tariff rates continue to be implemented. Domestic activity indicators have weakened in recent months for several economies. Industrial production has declined in Brazil, Germany, and Korea, and retail sales growth has fallen in China, the Euro area, and the United States. Following growth of 3.3% last year, we now project global growth of 3.2% this year and 2.9% next year. Compared with our last economic outlook from June, these projections are up by 0.3 percentage points for this year and unchanged for next year. Among the OECD countries covered in this interim economic outlook, the most significant upward revisions are for Japan, Mexico, and Turkey. The expected decline in global growth over 2024 to 2026 in part reflects high trade barriers and policy uncertainty, which are set to continue holding back business investment and trade. Inflation is projected to decline in most G20 economies as growth and labour markets moderate. We project headline inflation across the G20 to decline from 6.2% last year to 3.4% this year and 2.9% next year. One exception is the United States, where we expect tariffs to push inflation up from 2.5% last year to 2.7% this year and 3% next year. In terms of risks, in particular in relation to trade, inflation, and financial markets, they remain significant. Additional increases in barriers to trade or prolonged policy uncertainty could lower growth by raising production costs and weighing on investment and consumption. Inflation pressures could resurface, for example, if further rises in trade restrictions or geopolitical tensions push up prices. Goods price inflation across OECD countries has ticked up over the past year, including as a result of higher food costs and services price inflation still being elevated. High asset valuations, especially for technology stocks and crypto assets like Bitcoin, also heighten financial market vulnerabilities to negative shocks. On the upside, measures to lower trade barriers and reverse tariff increases could improve sentiment and support activity. We need the right mix of policies to reduce uncertainty and reinvigorate growth. First, constructive dialogue between countries remains a key priority to ensure a lasting resolution to trade tensions. All other things being equal, well-functioning, open global markets mean stronger growth, higher incomes, lower costs, and better living standards. We need to continue to draw on these very real benefits while tackling genuine concerns around unfair trade practices and unlevel playing field, supply chain resilience, in particular on key strategic product lines, and more generally, economic security. Our strong advice to all governments, in particular market-based democracies, is to work together bilaterally and multilaterally to find the best possible ways to make our international trading arrangements fairer and function better in a way that preserves the economic benefits of open markets and rules-based global trade. Second, central banks should continue to be vigilant in view of the high level of uncertainty. Monetary policy needs to respond promptly to shifts in economic or financial developments that may pose risks to price stability. Policy rate reductions should continue in economies in which inflation is expected to moderate towards the central bank's target, provided inflation expectations remain well anchored. A third, fiscal discipline is necessary to safeguard longer-term debt sustainability, to make fiscal space to deal with structural spending pressures and to respond to shocks. Rising spending pressures, including from population aging and defence requirements, are coming at a time when public debt across the OECD already stands at 112% of GDP, up from 73% of GDP back in 2007. Debt service costs are rising as low-yielding debt matures and needs to be reissued at higher rates. Systematic and regular spending reviews, strengthened public procurement practices, a greater use of digital technologies and better targeting of social benefits would raise public spending efficiency and free up spending for areas that better support opportunities and growth. Fourth, ambitious structural reforms are important to boost prospects for growth over the medium to long term. Current potential GDP per capita growth in the OECD is estimated at 1.3%, down from around 2.4% in the 1990s. To unlock stronger growth and economic dynamism, we need to boost competition between firms, facilitate skills development, and raise business investment, including in AI and other digital technologies and research and development. Digital investment must accelerate, particularly in Europe and Japan, when compared with the United States. For example, over the past 10 years, real business investment in software and data has grown by 159% in the United States, compared to just 55% in Europe and 8% in Japan. We estimate that even in a scenario of slow adoption, AI will contribute between 0.2 and 0.4 percentage points to annual labour productivity growth in G7 countries over the next decade. Policies that enable faster adoption of AI and of digital tools complementary with AI, for example, relevant software, would boost these gains by an additional 0.7 to 0.9 percentage points. In conclusion, while the global economy has remained resilient so far, the signs of weakening activity highlight the importance of multilateral cooperation on trade, vigilant monetary policy, fiscal discipline, and ambitious structural reforms. By acting decisively, governments can reduce risks, strengthen resilience, and ultimately achieve sustained increases in living standards. Thank you, and with that, I pass the floor to our Chief Economist, Alvaro Pereira, to present our analysis in some more detail.
Thank you very much, Secretary General. Good morning. I would like to first thank my teams from the front office to the PRB branch and our desks for all the work. The overarching topic of this presentation is basically trying for countries to find the right policy balance in uncertain times. So let me walk you through what we see in the data first, and then what we see in terms of the main risk and what the main policies that are warranted at this moment. So we'll start with activity indicators. So as you can see in this graph, in the past few months, there's been activity that has become more resilient, and so activity indicators have been positive in spite of all the uncertainty. On the other hand, as you can see clearly in this graph, a lot of firms, especially in the first quarter, front-loaded a lot of their trade activities before tariffs were implemented. And then afterwards, they adjusted afterwards. They accumulated a lot of stocks and they were able to and inventories, and they were able to afterwards to try to overcome the challenge. And related to this, it's one of the graphs that I think I would like you to pay close attention, which basically tells you, what is happening right now in terms of the effective tariff rate for the United States in the past few decades. And you can see at the end of the graph two lines. One of the line, the blue one, is the U.S. effective tariff rate, which basically is the announcement and been legislated in terms of tariffs. And the green line is the tariff rates based on duties as share of import values. What the lines are saying, if they in normal circumstances they'll be coinciding, but you can see that they are diverging. What it means is that the full effect of tariffs has not been fully incorporated into the economy. So there will be further impacts in terms of growth, and in particular in terms of inflation, that when all the impacts of the tariffs are incorporated by firms and so on, then the two lines will converge towards the tariff rates that have been legislated. On the other hand, also important to say that labor markets have been easing. In some countries, unemployment rates went up a little bit, not much, but a little bit. But on the other hand, if you remember a few months ago, and especially about a year or 2 years ago, we were concerned with severe labor shortages in many countries, which meant that vacancies were very high, and some of a measure what economists call tightness of the labor market, which is vacancies per unemployed, were also very high. What you can see in this graph is that basically this has come down quite significantly for most countries. So labor markets are easing, and in fact, in certain countries, as I said, they deteriorated a little bit. So by taking into account all these data, what can we say about the new projections of the OECD? Well, you can see the new projections in this table. As the Secretary General mentioned, we forecast growth of 3.2% this year, 2.9% next year. Important to say that the uptick that we see in global growth is mostly due to the revision in some emerging market economies. There was an agricultural bumper crop in Brazil. There was an issue with deflators, GDP deflators in India. There was an unexpected increase in investment in Indonesia. And this has allowed, and better data because of the front loading of trade, this has allowed for better data this year. Having said that, we see that for the next few months, that activity should be affected, as I explained and the Secretary General also mentioned. So consumer and business confidence will be affected, and we expect somewhat slower activity going forward, and so that we have growth of about 2.9% next year. If you look at major economies in the United States, growth will slow down from 2.8% last year to 1.8% this year and 1.5% next year. Still very robust growth, and I'll come back to that partly because it's because of the AI boom that you see in the economy. On the other hand, we can see that in Europe, growth will be around 1%. With countries like Germany accelerating next year due to the fiscal package and more military spending and infrastructure spending, whereas other countries like France will grow about 6.6 this year and 0.9 next year. In Europe, Spain continues to do better thanks to tourism and immigration and consumption. And on the other hand, we can see that in the emerging markets, China is expected to grow about 4.9% this year, but slow down to 4.4% next year, in spite of a large fiscal package, but also due to the ongoing readjustments in the real estate market. In India, growth has been robust this year to 6.7%, but will be about 6.2% next year. And overall, as I said, we see a picture of our forecast last year from 3 months ago have not changed dramatically, with some exceptions, a few countries for those idiosyncratic shocks that I mentioned before. If you look at inflation, inflation is moving in the direction that we expected, with 1 or 2 exceptions. We just heard the Secretary General mention that our forecast for the United States entails a bit less inflation than we have forecasted 3 months ago. This is mostly due to the fact that, as you saw in the tariff rates, many of the tariffs have not been, the impacts have not been fully incorporated into the calculations and into the firm's behavior. But on the other hand, we expect a bit more inflation next year, about 3%. Most of the countries, we can see that the inflation is moving towards target, even though, as I'll come back a bit on this as well, goods price inflation has ticked up a little bit in certain countries. With this, what are the main risks that we see going forward? First of all, we know that there's a lot of debt, and I'll show you a picture later on about debt, public debt in many countries. And spending pressures are only rising. So we start already with many countries with very high debt, and spending pressures are rising, both in terms of aging cost, the green transition, but also military spending, which means that because there's so much debt and pressures to spend more, the perceived risks, fiscal risk for countries are increasing, as you can see in the bond yields in the graphs. On the other hand, another risk that we're monitoring very closely is risks linked to financial stability. valuations, we've been highlighting this in the past few months, valuations are historically high in many countries, and in particular, valuations of many digital companies have been going up quite significantly. Here you have the Magnificent Seven, the so-called Magnificent Seven shares. They have doubled in price in the last 2 years. But on the other hand, we also have gold that has more than doubled in price in the past 2 years, and crypto actives. There's been a significant increase of their valuations. We have Bitcoin here, which has quadrupled in price in the last 2 years, but many other crypto actives, there's been a very substantial valuation. And so if there's a negative shock, there might be possible of some sort of repricing. So obviously this is a consequence, risk of, for financial stability going forward. Another risk that we see is that obviously in terms of inflation, remember service price inflation remains sticky in many countries of the world, but goods price inflation has started to tick up a little bit, not dramatically, but a little bit in certain countries. Part of the reason for that is food price inflation. And you can see countries like Japan, where rice prices increase fairly substantially, and food price inflation increased by 8% in Japan. But other countries like Brazil, South Africa, Great Britain, there's been an increase in food price inflation. So that means that goods price inflation is also starting to have pressures from this. And so there's a risk that obviously food price inflation could drive further goods price inflation and overall inflation. On the other hand, going back to the debt issue, and as you can see in our recent global debt report, there's a lot of debt that needs to mature in the past few years. In particular, if you look at the purple columns for low-income countries, a lot of that has to be refinanced in the next couple of years, or 2 or 3 years. Whereas for high-income countries, the refinancing usually happens a bit further down. And so obviously there's the risk that some refinancing might be difficult, especially for countries that have very high debt. And so there's the risk that of refinancing this debt. What about policies? What do we have to say about policies regarding right now? As the Secretary General mentioned, the most important thing is in terms of trade. You can see the graph that trade to GDP ratio has been fairly constant in the past few years. But we think that is very important, knowing that trade is such an important engine of growth, that countries reduce barriers and continue negotiations to try to lower barriers and to get a resolve trade tensions. Secondly, in terms of monetary policy should remain vigilant because, as I just told you, we know that service price inflation has been fairly sticky, goods price inflation has ticked up, and in certain countries, even though if inflation is our expectations, there's margin to lower rates. In other countries, like Japan, we see an increase in rates, whereas other countries, there's a margin to lower a little bit the rate. So what we think is most important thing is that monetary policy should remain vigilant and data dependent. On the other hand, this is a graph that we've shown several times on that. This is debt to GDP ratio. In 2007 and now in 2025, what is striking about the picture is that with one or two small exceptions, we have basically all debt increasing fairly dramatically in the past few years. We could show you the picture also for low-income countries, for emerging markets, and the picture will be similar. So that has risen quite substantially. And since these are the spending pressures that I mentioned for defense, for green transition, and for aging costs, it's absolutely essential that countries go back to fiscal discipline and ensure that that is in a downward trajectory so that later down the line in the future we don't have issues with refinancing debts or other issues related to debt sustainability. On the other hand, one of the most noticeable changes that we've seen in the world economy, and in particular in the U.S. economy, has been investment surging. If you remember, 3 months ago, our special topic of the economic outlook was about investment and tried to explain why investment was doing much better in the United States than other parts. This is a picture that you see here. Investment continues to do very well in the United States. In other parts of the world, not so well. And this time around, we are digging a bit deeper and try to understand the underlying causes, in particular with digital investment, and to see what is, in terms of digital investment, what is happening there around the world. And in fact, in the next few weeks, we're going to launch a paper, a new report showing exactly more data about this digital investment. Well, if you look at the left-hand picture, you can see that the United States in terms of R&D, in terms of data, in terms of software, and in terms of other ICT developments, is basically surging ahead compared to everybody else. So digital investment is much stronger in the United States than you see in Europe and Japan, but if you look at other parts of the world, it will be very similar. So the United States right now is by far leading not only the AI boom, but basically the digital boom that you see in the world, in the economy. On the other hand, if you look at the blue line is basically investment in machinery and equipment. You can see that machinery equipment in the United States is not doing so well compared to Europe and Japan. But again, the digital investment is so strong right now that it's over dominating everything else. On the other hand, we also know that in terms of policies, if you want to realize the gains from AI and the digital investment, you need to have a lot of energy. A lot of these new technologies are highly energy dependent. So this is a graph that it's with the data from the IEA and gives you three scenarios. A baseline scenario, which is the blue line, and a scenario where you have more energy efficiency, and another scenario in which there is a faster diffusion of AI, according to our own calculations that we had recently in a paper that we produced for the G7. And what you can see is basically if AI diffuses very fast, the increase in electricity demands are going to be tremendous. We're talking about by 2035, we are going to need to have an increase in energy demand that is as big as all the energy demands of India right now. So it's a dramatic increase in energy that we need to do. And so countries around the world, if they want to continue to bet on AI and digital technologies, they need to invest more in energy demand and do whatever they can to reinforce grids, modernize their electrical systems, and so on, so that they are able to meet this demand. On the other hand, we also think that there's still too many barriers to entry, too many barriers to competition in many countries, in many of these sectors, which means that since you don't have enough competition in many of these sectors and too many barriers to entry, given by this our product market regulation indicators, this means that many of the gains that you can get from AI are not fully realized because unless you do these reforms to reduce these barriers. Another reason why it's important in order to invest more in AI is to address skill shortages. This is a graph from a recent survey that we did for 36 countries. And these skill shortages show, and this graph is basically showing that in the United States, for example, and in Germany, between 30 and 40% of firms are facing severe skill shortages right now related to ACT. If you want to have fast diffusion of AI, you need to have people with the right skills. But if you have these big shortages in labor, what can you do? Well, you can invest in the skilling of these people. You can obviously have immigration policy to try to attract talent. And you can do whatever you can, in fact, to try to address these shortages as soon as possible to boost productivity. And finally, what's the result of all this? The Secretary just mentioned as well. Well, according to our long-term model, the impact of fast diffusion of AI could be very significant. Here in the graph, you have on the left-hand side advanced economies. What do we expect that will happen without structural reforms? The baseline means if nothing happens, there's no structural reforms to boost competition or to boost productivity. And if there's no fast adoption of AI, the baseline scenario means that potential output growth will grow a little bit, but not so dramatic in the next 25 years. But if countries do structural reforms that the OECD has been arguing for several years, and also we are able to meet the conditions to have fast diffusion of AI, you can see that there's going to be a big increase in potential output, in productivity, which means that living standards will grow a lot faster. The same is true for developing countries and for emerging market economies, as you can see on the right-hand side. And so we hope that countries right now do whatever they can in order to do the reforms that they need and also to meet the demands for digital investment and AI development that are important for them to have more growth. So let me just conclude what do we see right now in terms of the economic outlook. We think that it's very important to say that even though in spite of pervasive uncertainty, we know that the world economy has been fairly resilient, partly because of front-loading and partly because investment and consumption has done relatively okay in many countries. However, we think that going forward is very important to countries to reduce tensions in terms of trade tensions and lower trade barriers. Monetary policy should remain vigilant. Fiscal policy, it's absolutely essential to go back to discipline, fiscal discipline. And as always say in terms of structural reform is absolutely essential for you to boost growth and prosperity and living standards in the future. Thank you.
Thank you, Alvaro. We'll now move to questions. A couple of people asking related to business investment. I'll paraphrase, particularly in digital, on the gap between the US, Europe and Japan. What impact is that having on productivity growth, and what can the EU and Japan do to reduce that gap?
Well, higher investment will mean higher productivity growth. And lower investment means that the gap between the US on one side and Europe and Japan on the other will continue to grow. So, what we say very clearly to Europe, at 55%, I think we said, of investment, and Japan at 8%. Time to really ramp that up if you want to remain internationally competitive and if you want to really draw on all of the potential upside opportunities of the productivity enhancing effects of more accelerated diffusion of AI.
Thank you. We have a question from Matt Cranston from The Australian, very specific, asking why the OECD slightly increased its inflation forecast for Australia's headline and core inflation figures.
Well, there was only a small uptick that really what matters for Australia is that Australia continues to be within the target range that they have. We also expect that this will continue to be so in the next few months. Not only that, we also expect that the Australian economy will start, growth will start picking up a bit further. So we are not overly concerned about this uptick. It happened in other countries.
So Ángel Calvo from the Spanish press news agency EFE. Can you say us something more about what you were saying, that the technology values are quite high in many countries, but at the same time you are saying that more investment is needed, especially in Europe and in Japan, in this industry. So there's no contradiction. At the same time you are saying investment in this sector is needed because it will allow more productivity, but at the same time you are saying that high values are in the market in this industry. And I have another question about the implication of the Trump tariffs. You have said that the main losers will be the US, Mexico and Canada. And so do you think they will be the main losers in the medium and in the long term? And at the contrary, which will be the main winners of these Trump tariffs?
Well, in terms of the high valuations and digital investment, we've been highlighting in terms of high valuations for a few months. If you compare valuations compared to historical values, it is true they are high. What we say is that it's possible that the returns that the markets are thinking that they will get are not materialized. That could be a correction. That's all we're saying, okay? But it's absolutely essential to say also that one of the great developments that we see right now in the US economy, but also the world economy, is exactly the diffusion of the so-called new general purpose technology called AI, artificial intelligence, which linked with the computers and the internet is likely to lead to a significant restructuring and reorganization of our work practices, of the way that we work our economies, and also in terms of jobs. So we think that it's absolutely essential to have more investment because we know that, and we estimate this, that the impact on productivity is going to be very significant. As the Secretary General just mentioned, there's a very high correlation between investment and productivity. And so more investment in these areas, which we expect that will lead to a lot more productivity. So there's no contradiction there. It just means that we know that in terms of the real economy, a lot more investment is needed, not only for the United States and Europe and Japan, but also for the rest of the world. Remember, developing countries can also try to catch up faster if there's a faster division of digital technology. I'll just give you an example that is quite important, which is India. India jumped several hurdles regarding in terms of the diffusion of technologies, partly because they were so enthusiastic to introduce many of these digital technologies, and the government was actively doing that in terms of financial inclusion and many other initiatives. So we expect also that this will have a significant impact for developing countries. The other question that you have in terms of the implications of tariffs, you said that, well, we estimated in the past that the impact will be strongly felt in the United States, Canada, and Mexico for the simple reason that these countries are very integrated, and so the estimation shows that they'll be affected in terms of a bit more inflation and a little bit less growth. What I think is important to say is that in the next few months, and these countries are engaging into important dialogue. In the next few months, it's important that this dialogue will lead to even further trade agreements and reduce trade barriers so that they have a boost growth. And I think that's the most important thing to say.
Just also to add to those two questions. I mean, when it comes to the investment and the productivity-enhancing investment of investment in software and data, we're looking at the facts and we're looking at the figures, and what we see is that AI-related investment has boosted growth in the United States. What we see is that productivity growth in the United States is stronger than in Europe and in Japan. And what we see is that over the last 10 years, real business investment in software and data has grown by 159% in the United States, compared to 55% in Europe and 8% in Japan. Now, if we can agree that the increased and the accelerating diffusion and adoption of AI will have a productivity-enhancing effect, then it stands to reason that the more you invest, the more you can optimize the productivity-enhancing effect. And the data certainly would seem to suggest that in the US it is having an effect, and Europe and Japan should consider following suit. But it's not just the investment point. There's also, of course, the skills development point. We need to make sure that we have the human capital that is able to take all of that forward. Now, in relation to the medium to long-term effect of tariffs, I mean, over the medium to long term, what we say is what would be most beneficial to the global economy and to economies around the world is for there to be a lasting resolution of current trade tensions, and for any efforts to make international trading arrangements fairer and function better in the context of concerns that have been identified, that it would be best if that could be done in a way that preserves the economic benefits of open markets and rules-based trade. And that requires dialogue. It requires bilateral and multilateral dialogue and cooperation in finding the best possible way forward. In the end, a sustained trade war will have no winners. It will only have losers. Open markets and rules-based trade offers the opportunity of stronger, sustainable growth and increases in incomes, reductions in costs, and increases in living standards. And that is, obviously, that is what we very much suggest to countries they should work towards for the benefit of their populations.
We have a question from Tim Wallace from the UK Daily Telegraph asking whether the UK is at risk of stagflation.
Well, we right now we expect, in fact, growth will be a bit stronger this year than anticipated. Inflation, even though has been a bit higher than in Europe, we expect that it will come down. And so, because inflation is coming down and growth will be more or less around potential, that is not certainly our working assumption.
Thank you. We have a question from Paolo Levi from Italian news agency ANSA asking what your main message for Italy would be in terms of controlling its public spending and finances and relaunching growth.
Well, I think in terms of public expenditures, I think it's important to say that Italy is in a better place than used to be a few years ago. But it's important to continue, because that level continues to be high. It's important to continue the efforts in the next few years, not only this year and the next, but the next few years, to continue to reduce debt. remember, why do it's important that countries reduce debt when they have very high debt levels? First, if you have very high debt levels, then you're going to spend a lot in interest payments. So rather than spending on education, social security, and health and others, you'll be spending in interest. Second, you also know that very high debt levels makes you vulnerable if there's crisis. So not only makes you vulnerable, but you have less margin. So remember, in the last 5 or 6 years, we had a pandemic, a huge energy crisis after Russia's invasion of Ukraine, and we had also uncertainty related to tariffs. So these big shocks, if you don't have any margin, because your fiscal, you don't have fiscal space, that means that the country will not be able to have a decisive answer if needed, if it is needed. So maintaining low debts is important exactly to have these buffers in case of a shock and to make the country less vulnerable. So on the other hand, in terms of structural reforms and in terms of what Italy needs to be done to do, well, Italy needs to continue to reform. We think that reducing bureaucracy, red tape, simplifying regulations, trying to reduce complexity of regulations and also boosting competition is going to be key. We highlight this throughout the years. And something that is important to say, also continue to invest in skills. We just heard from the Secretary General, investing in skills is absolutely essential. And so I think this is an area where Italy should also concentrate itself.
Thank you, Alvaro. We have a question here about the forecast. Why was the 2026 growth rate forecast in the world kept at 2.9%? If the upfront investment ends in 2025, then the 2026 forecast should surely be subject to a downward revision. Is it due to robust corporate earnings and vigorous investment?
Well, our forecasts are basically, whenever you calculate the global forecast, it's an average of what we see in the world economy. So every single desk of every single country and the rest of the economies, our macroeconomic policy division, take into account what you see in terms of the data, what do we expect will happen in the next few years. We take into account what countries and governments are planning to do. And then we calculate, basically, and we try to estimate what's the forecast. Our forecast for next year is basically the same as it was 3 months ago. And we see the world economy growing around a bit less than 3%. Remember, when the world economy used to be in cruise control, it used to grow around 4%. Now we're talking about a bit less than 3%. And a bit less than 3% means that you're going to have, obviously, less job created and it'll be less prosperity for people. So we think that it's very important to continue to have the reform and find the right policy balance in order to address this issue.
Thank you. We have one last question here from Richard Hill from Les Echos, who asks, do you think that the main messages issued by multilateral organizations like the OECD are listened to by governments around the world? Are your voices heard?
Well, look, it's a marathon, not a sprint. And, in the end, it's our job to report the data and the facts and the figures as we see it and to suggest what we believe the policy implications of the data and the figures are as we see them. In the end, it's up to democratically elected governments or governments around the world to make judgments. But we hope that we can help inform better decisions for better outcomes over time. And we will be persistent in our efforts on that front and hope that over the medium to long run, we will help countries move into the best possible trajectory for the future, delivering better outcomes for people.
Thank you, Secretary General. Thank you, Alvaro. We'll close this press conference. Thanks, everyone.